This year, the UK must borrow £131 billion in order to repay its old debts and meet the day-to-day costs of running the country. This is a massive jump since 10 years ago. It does this by selling government bonds, or gilts, a sort of IOU which promises to pay investors back their money plus interest at a later date. Gilts are one of the oldest securities in the world, tracing their heritage back centuries to King William III's need to fund a war in France. Whereas in the past, investors would receive a physical proof of debt, nowadays most gilts are traded electronically. But to keep its debt funded, the UK has become increasingly reliant on the kindness of strangers, meaning international overseas investors. Here in these rather anonymous-looking offices is where the monumental task of selling the UK's debt happens. But the days when the head of this office could gather domestic investors over a cup of tea to discuss the government's borrowing needs are long gone. Now the UK must compete on a global market. Overseas ownership of gilts has been steadily rising in recent years, as the UK attempts to diversify its investor base. Over time, ownership of gilts by domestic investors like banks and insurance companies, which used to hold the majority of bonds, has fallen. And a new buyer has appeared thanks to the Bank of England's post-crisis bond buying programme. But overseas investors are the group that attract particular attention, with China, Norway and the US all responsible for some of the largest holdings of UK government bonds. The Bank of England recently cut interest rates to a record low and restarted a bond buying programme, which explains why the UK's average cost of borrowing has dropped from about 5% before the financial crisis to below 1% now. But placing UK debt in the hands of investors is a delicate balancing act because of the scale of borrowing. Every month, the UK has to sell around £11 billion worth of gilts in global markets, double the amounts it was selling a decade ago. This is why the volume of outstanding gilts has more than tripled in the last decade to £1.5 trillion, equal to about £25,000 for every man, woman and child in the country. There have been other times in history when public sector debt has jumped in a short period of time. In the aftermath of the Battle of Waterloo and the Second World War, debt as a percentage of GDP rose sharply. So while the outstanding amount of debt might sound alarming, investors and economists pay more attention to this figure compared with the size of the economy or the nation's gross domestic product. In the UK's case, this is now just under 83%, which is neither the largest in the world nor the largest in the UK's history. Since the vote for Brexit, the value of sterling has weakened considerably, which might make international investors more cautious about the UK. But the sell-off in gilts that some people worried might accompany the vote hasn't happened. But then, until the UK triggers Article 50 and begins proceedings to move away from the EU, the full ramifications of that vote on the gilt market cannot be guaranteed.